Hi. Well, we're now at the back end of 2013 and investors are getting more optimistic, markets are getting buoyant, and in this kind of environment, I think you can expect a lot more takeovers than usual. So I thought it'd be a good time to do a quick video on how takeovers work and look at whether private investors can make money from takeovers. So I'm going to start with just a really quick overview of how takeovers work. Let's imagine we've got two companies, Company A and Company B, and they operate in the same industry. We'll say the widget industry. So here we go. We've got Company A and Company B. And probably Company A wants to buy Company B normally to save money. They think they can save money by merging the two companies together and then lay off some staff, people in sales, marketing, all the rest of it. So the first step is the directors of Company A approach the directors of Company B and say, we'd like to make an offer, we'd like to buy. They say how much money they'd like to offer, and actually the purchase price could be paid in cash or actually in shares in Company A. So that's the beginning of the process. The offer is made. And the directors of Company B then have to give an answer. They may say that's a good deal and they'll recommend the offer to the shareholders of Company B, or they may reject the offer, and if Company A decides to carry on, it'll then be a hostile bid. So the first thing is the offer's made. Then, within the next month, you'll get the offer document. And that's then sent to all the shareholders in Company B. And Company A will outline why they want to buy Company B and how much they're willing to pay. And if the directors of Company B are recommending the offer, then they'll also have a section in the offer document in which they say why they think the takeover is a good deal. If, on the other hand, the directors are rejecting the offer, they then put out a defense document which says why they think the deal is a bad idea and shareholders shouldn't sell out. And let's remember, it's always the shareholders in Company B who make the final decision. And then we get to the stage where we learn whether the deal has succeeded or not. So to succeed, we need to get acceptances from the owners of 50% of the shares in Company B plus one share. And if Company A gets that, they've succeeded. Now, if they get 75% of the shares, they then have greater power. They can pass special resolutions. They can make bigger changes in the company. And if they get 90% of the shares, then they get total control because they can buy the remaining 10% with compulsory purchase, if you like. The shareholders are obliged to sell. So that's a quick overview on how it works. If you're wondering about regulation, it's mainly regulated by something called the Takeover Panel. And then the competition regulators come in. So even if the shareholders of Company B have accepted the deal, the competition regulators may say it's no dice, they may overturn it. They'll be concerned if they think the merged company, let's call it AB PLC, has too much power and could drive up prices and put any rivals out of business. So in the UK, something called the Office of Fair Trading will look at the deals. They might recommend to the Competition Commission, say to the Competition Commission, you need to have a look, and the Commission will then decide whether the deal's anti-competitive or not. And if it's a larger deal, the EU will get involved and again give a verdict on the competition issues. So now we know how it works. The question is, can private investors make money out of takeovers? Should we go out looking for potential takeover targets and hope to make a profit? And there are plenty of people who think that is a good, sensible investment strategy, but me personally, I'm not so sure. One of probably the most cited potential takeover target at the moment is Vodafone. Vodafone recently sold its North American business, so now it's quite a pure European and emerging markets business. And people think AT&T might launch a bid. But I would never buy shares in Vodafone purely because of bid speculation from AT&T. For me, it only makes sense to buy Vodafone if you think the current share price is cheap. You need to see opportunities for growth there. You need to think Vodafone can prosper as an independent company and you'll make a decent profit over the medium to long term. Then if the takeover comes along, it's kind of a welcome bonus and it's a catalyst for you to achieve your profit as a shareholder. It speeds up the profit process and it is a very, very welcome bonus. But if you buy Vodafone and you actually think the current price is a little bit expensive even now, the danger is you can wait a long time for a bid, the bid may never come, and when the market as a whole realizes the bid isn't going to come, the share price can actually fall and you'll end up making a loss. The other thing that's worth looking at is an issue of what about if you own shares in company A when company A launches a bid? Is that good news for you as a shareholder in a company that's trying to buy another one? And sadly, more often than not, that's bad news for shareholders. There's been a lot of academic research that shows that takeovers tend to destroy shareholder value. There's several reasons for that. One is that CEOs tend to have big egos, they get carried away, and they pay too high a price to make sure the deal is done. You also get investment bankers trying to encourage these mergers because they can get nice big commissions. And also, actually merging two companies together is quite complex. You've got to merge all the IT, you've got to merge the company culture. It can actually be a lot more problematic than you might think. And I mean, a few years ago when Safeways and Morrisons merged, Morrisons bought Safeway, and it was all a bit of a nightmare for several years until things were sorted out. And it wasn't a great deal for the shareholders in Morrisons who were buying Safeways. And another example, is RBS. Just before the credit crunch hit, RBS bought ABN AMRO. It was a terrible time to buy another bank. It destroyed masses of shareholder value for RBS shareholders. So that's a really quick look at how takeovers work. And I hope I've shown that they're not really a great money-making opportunity for private investors. I'll be back with another video soon. So until then, good luck with your investing.